When it comes to building wealth for the future, the debate between the traditional 401k and the Roth IRA is often framed as a simple choice. However, as the stories of two investors, Jake and Marcus, illustrate, the reality is far more nuanced. Both men are 30 years old, earn an annual salary of $75,000, and live in the same city with identical tax burdens. They share a singular goal: to reach retirement age with enough security to never worry about a price tag again. Yet, 30 years later, despite following their respective plans to the letter, they find that the numbers on their bank statements tell only half the truth. One forgot to account for what the government takes on the way out, while the other overlooked what he sacrificed on the way in. Jake represents the traditional path. He enrolls in his company's 401k plan, a move that feels like an immediate win. His employer offers a 4% match, providing him with $3,000 in free money every year. Jake decides to contribute 10% of his gross salary, amounting to $7,500. Combined with the match, $10,500 enters his account annually. Because these contributions are pre-tax, Jake's take-home pay doesn't feel the full weight of his savings. To the IRS, it's as if he only earned $67,500. This immediate tax break saves him roughly $1,650 in federal taxes every year, capital he can use for his daily life today rather than decades from now. On the other side of the fence is Marcus, who chooses the Roth IRA. He contributes the same $7,500, but because there is no employer match for a Roth, his total annual investment is lower than Jake's. Furthermore, Marcus receives no tax break today. Every dollar he puts into the Roth is after-tax money. To get $7,500 into his account, Marcus effectively has to earn about $9,600 in gross pay because the government takes its cut before the money ever touches his investment. From day one, Marcus's lifestyle feels more restricted than Jake's. While Jake sees a booming balance and a fatter paycheck, Marcus quietly builds a smaller pile of money that has already survived the tax gauntlet. The midpoint: perception versus reality. Fast forward 5 years, and the visible scoreboard heavily favors Jake. His 401k balance has surged to over $64,000, bolstered by the employer match and the larger volume of pre-tax dollars. Marcus, meanwhile, sits at roughly $46,000. At social gatherings, Jake is the one people ask for advice. A 401k feels like a power move because the numbers grow so quickly. However, a silent shift begins around year 7. While Jake's account is undeniably larger, it carries a hidden liability. Every dollar in that 401k is essentially a joint account with the IRS. Jake is the manager, but the government is a silent partner waiting for its share of the profits. By year 20, the discrepancy is even more jarring. Jake's balance has climbed to $461,000, while Marcus sits at $329,000. On paper, Jake is winning by a landslide. But if they both needed to liquidate their accounts, the after-tax reality would set in. Assuming a 22% tax rate, Jake's actual wealth is approximately $360,000. Marcus, however, keeps every cent of his $329,000. When you remove the employer match from the equation, the two are almost identical in actual purchasing power. This is the psychological trap of the 401k. The balance looks impressive, but a significant portion of it was never yours to keep. You are simply holding it for the government until the day you retire. The Retirement Reveal. At age 62, both men hang up their hats. Jake is a 401k millionaire with a balance of $1,238,000. Marcus has $885,000. To the casual observer, Jake has won. But the true test begins when they start withdrawing $60,000 a year to live on.
When Jake pulls $60,000, the IRS views it as ordinary income. After deductions, he owes about $5,100 in federal taxes, leaving him with $54,900. If he lives in a state with income tax, that number drops even further. Marcus pulls his $60,000, and because he paid his taxes 30 years ago, the IRS asks for nothing. He keeps the full $60,000. Over a 25-year retirement, this tax gap becomes a chasm. Jake will pay approximately $127,000 in federal taxes just on his withdrawals. But the Social Security trap adds insult to injury. Because 401k withdrawals count as income, they can trigger taxes on Social Security benefits. For Jake, this could mean an additional $61,000 in taxes over his retirement. Marcus's Roth withdrawals are invisible to this calculation, allowing him to keep more of his government benefits tax-free. When the dust settles, Jake may have started with $1 million, but he will pay nearly $200,000 in taxes that Marcus completely avoids. Flexibility and the unexpected. Life rarely follows a linear path, and this is where the Roth IRA reveals its secret weapon: flexibility. Imagine both men face a $30,000 medical emergency at age 50. Jake turns to his 401k and is immediately hit with a 10% early withdrawal penalty plus income taxes. To get the cash he needs, he has to surrender nearly $10,000 to the government, walking away with only $20,400. He is penalized for accessing his own savings. Marcus, however, can withdraw his original contributions, the principal, from a Roth IRA at any time for any reason without taxes or penalties. Having contributed for 20 years, he easily pulls out $30,000 of his own money. He loses nothing to the IRS. In this scenario, the Roth IRA acts as the ultimate emergency fund, a safety net that the 401k simply cannot provide without heavy financial consequences. The case for the 401k. It would be a mistake, however, to claim the Roth IRA is the undisputed champion. The 401k possesses structural advantages that the Roth cannot touch. The employer match is arguably the greatest return on investment available in the financial world. By contributing just enough to get the match, Jake received $96,000 in free capital over his career, which grew into over $350,000. No tax advantage in the world can compete with a 100% immediate return on your money. Furthermore, the 401k allows for much higher contribution limits. In 2026, the limit for a 401k is $24,500, compared to just $7,500 for a Roth IRA. For high earners, or those starting late, the 401k is the only vehicle that allows for the mass sheltering of income. There is also the benefit of tax arbitrage. If you are in a high tax bracket now, say 32%, and expect to be in a lower bracket during retirement, 12% or 22%, the 401k allows you to dodge high taxes today and pay much lower taxes later. The hybrid solution. A balanced blueprint. The mistake Jake and Marcus made was choosing a side. In the world of finance, the most successful investors don't pick one. They utilize the strengths of both. Most financial experts recommend a three-step hierarchy for retirement savings. The match first. Contribute to your 401k exactly enough to capture every penny of your employer's match. This is non-negotiable free money. The Roth second. Max out your Roth IRA. This builds a pool of tax-free capital that provides flexibility, protects against future tax hikes, and keeps your Social Security benefits safe. The 401k third. If you still have investable income, return to the 401k to maximize your contributions up to the legal limit. This lowers your current taxable income and allows you to save at a high volume. By following this Match Roth 401k sequence, you capture the free money, ensure tax-free growth, and maintain a high savings ceiling. You protect yourself against the RMD, required minimum distribution, trap, where the government forces you to take money out at age 73, and you create an estate that can be passed to heirs without a massive tax bill. Ultimately, the goal isn't just to have the biggest number on a screen, it's to have the most spendable money when you stop working. Whether the 401k or the Roth IRA wins depends entirely on your specific tax bracket, your career trajectory, and the future of national tax policy. But one thing is certain. The only way to play the game perfectly is to stop looking for a single winner and start building a strategy that accounts for what the government takes on the way in and on the way out.